Welcome to a conversation on profitability analysis of an organization. It can be a branch or any other profit center, but we're specifically focused on financial institutions. Hello, I'm Ed Ginn, and I'm here to walk you through the minefield of a lot of information summarized on one page, a simplified profitability report. The picture on your screen right now is that of a boat underwater, right? Well, did you know that 80% of the boats that sink at the dock, and their owners never know why? Was it a broken hose? Was it a loose clamp? Was it a small hole in the hull? Did the bilge pump not work? It doesn't matter. We're trying to help our bank friends understand, don't wait until the bank is sunk to find those profit leaks. Now we'd like to go through a single, simple, one-page report with you. This is a Palm Beach County branch number 2. This is a real bank, but it's been sanitized by name and a few numbers. The first thing you go to are the total deposits. Pretty healthy branch, $47,680,000. That comes from the general ledger or from the deposit application. Total gross loans. That means a combination of consumer, commercial, whatever you have booked in that particular organization. In this case, $42,940,000. Now we come down into the income. The deposit and loan income fees sometimes are a little more difficult because they're just not charged to that specific branch. But usually with a little bit of homework, you can come up from the general ledger or the application or a combination of those fees. Now the interest income is derived from the gross loans of that branch, booked in that branch. Now the last item under income is the funds earning credit. That's usually the big elephant in the room. That is the credit that we give the branch for putting that $47 million into the pool. We've determined a way that allows us to give credit or buy the money that they put into the funds that is a function of the true cost of funds. And that's what the webinar or the website will deal with in much more detail. So that gives us $1.2 million in our income. In a few minutes, we'll be talking about the funds use charge when you take out of the pool and are charged for it. The interesting part here is that you can be a branch that has only deposits, or you can be a branch that has only loans and still be profitable. Let's go to expenses, because we've come up with $1,283,000 in income. Now moving on to the service charges, or really all of the expenses of the branch, we'll begin by taking a look at the direct and the indirect expenses. This is typically referred to as the controllable expenses. It's the salaries of the branch employees, it's the occupancy expense, the utilities, typically comes directly from the general ledger. Also, we talk about the FDIC assessment, which can be calculated as a function of the deposits. The next grouping on this one-page report deals with service centers, and that is defining or expanding the general ledger into the proper number of responsibility centers that would be called service centers that support the profit centers. This is your data processing, deposit ops. This is the first time we're using activity-based cost accounting techniques. These come from basically manufacturing experience, but that's another story. So you see, data processing is charged out based on the number of loan and deposit accounts that are in that branch. Deposit ops, that's the backroom bookkeeping, and that's charged out based on the number of deposit accounts that that branch services. Item processing, that's deposit accounts only, and in some cases we add transactions or not, typically just the accounts. Loan operations, the same way. Network, a new thing in the world. It's so many $100s per month per workstation in that branch. We just talked about branch administration and operations administration. That depends upon the size of the bank itself. A larger bank will have some of these administrative groups, and a smaller bank may not. Now we move to the interest expense of $167,000. This is based on the actual interest expense from the deposits in that branch. It's determined by the mix and the rate that you're paying in the money from that branch. Branch got hot money, it'll show up here. Branch has a good balance, it'll show up here. Now the general overhead is a single number. I hope you notice that. My software development friends will brag to me about how their software can allocate 99 algorithms all kind of different ways. And the question is why? It's the fixed cost of operating the bank. The president's salary, director's fees, finance department, accounting, HR, whatever is a fixed cost doesn't need to go through multiple algorithms, but can be accumulated and allocated based on some fair basis to where it's one number. No, the branch manager can't control it, but it's his franchise fee. Finally, under expenses, we want to look at the funds use charge. Now that's the complement of the funds earning credit. In other words, this branch put money into the pool and now it's going to take it out. Notice no net use or net supplier of funds. This approach works whether a branch is a supplier only, a user only, or some mix. Again, I would refer you to our website or to further conversation to find out how we do this. And that brings us to the total expense of $1 million. Now that also shows us the difference, a net profit, and then we add a contribution to loan loss below the lines. Now be sure you understand that's the expense that's booked in the general ledger that bills the reserve. So now I have a profit after loan loss. Now what's on your screen right now is our approach to balancing to the general ledger. One of the most important things that we do and we think is extremely important is that any system must balance to the general ledger. Now, cost accounting by definition is not perfect. And what we do is our goal is to balance to the actual general ledger with no dummy profit centers or dummy products within 1%. On the screen, you're seeing an actual balancing analysis from a client just recently. Their net income from the profitability model was $519,000. The net income from the general ledger, actual for that same period, was $509. There was only $94 difference, or less than 1%. We have done that consistently and expect it to be a requirement of any valid cost accounting and profitability system. Let me sum up the 4 keys to achieving simplified profitability. Number 1, define and revise your responsibility centers within your general ledger to create a valid database. Don't be afraid to expand responsibility centers. Now, responsibility centers can be profit centers, service centers, general overhead centers. Next, choose to use activity-based charge-outs for your service centers. And it's an activity-based cost accounting system, not a negotiated cost accounting system. Choose a simple and accumulated one-line general overhead. Then find a fair way to allocate them. Quite often, those are allocated based on the non-interest expense of the branch. Finally, the big elephant in the room, buying and selling funds. It's not funds pricing. That is pricing for assets. It's not match funds. It's not multiple pools. It's a simple transfer rate based on the true cost of funds. Send me an email if you got a specific question. Go to the website if you want to see more or see some success stories. And finally, let us know if you'd like to set up a webinar. Thank you for your time and your interest. Good luck.